Hi friends, welcome to my YouTube class. As you know that the previous class we had discussed about the concept of depreciation. Depreciation is one of the non-cash expenses charged against the assets. It is allocation of assets over its estimated life of the assets. You know it. So today let's discuss about the methods of computing depreciation and the accounting treatment of the depreciation. That means that recording of depreciation in the books of accounts. Let's come discuss about the methods of depreciation. As we know that depreciation is to be charged against the assets. How it is to be calculated? That is the most important part. If you don't understand that how to calculate, then it is very difficult to recording. Where you will record, you know it. There is the books of accounts, there is the journal, then posted to ledger accounts. But before of that, it is important vital aspect to understand the calculation of amount of depreciation. For calculating the amount of depreciation, there are two methods used. The first method is straight line method. The second method is written down value method. Shortly we call it WDV method and shortly it is SLM method. Straight line method. Let's come to the first method, that is the straight line method. This method is also known as original cost method or fixed installment method or the fixed rate of depreciation method. That means the amount of depreciation charged under this method is fixed every year. Suppose say a machinery is purchased for 1 lakh rupees and the life of the asset is 10 years. Then first you have to calculate the amount of depreciation. Same for both the first straight line method or the written down value method. You have to calculate the first amount of depreciation. That is the amount of depreciation is to be calculated. That is the cost of assets. That is the total cost. That is the cost price you paid plus installation charges plus loading, unloading, freight charges. Everything will be added. That is the cost price of the cost of the asset, excluding GST. GST will not be included. So that is the cost of the assets minus scrap value, the residual sell value of the assets at the end of its life of the asset. So that is the scrap value. So this is to be subtracted from the cost of the assets divided by estimated life of the assets. That means suppose a machinery purchased for 1 lakh rupees including all charges minus scrap value of the machinery. Suppose the scrap value is 0, no scrap value. The estimated life is 10 years divided by 10. So this comes certainly the 1 lakh minus 0. So 1 lakh divided by 10, it comes, that is the amount of depreciation will come 10,000 rupees for 10 years. So multiplied by 10, 1 lakh, that is the allocated assets. So then rate of depreciation, you have to calculate the rate of depreciation. That amount of depreciation 10,000 divided by cost of assets 1 lakh. So this is 10,000 divided by 1 lakh multiplied by 100 equal to 10%. So that is the percentage comes 10. So this is the rate of depreciation, you know, calculated it. Now let's come to the method. That is the straight line method or written down value method. You have to follow this calculation for calculating amount of depreciation. Then rate of depreciation under straight line method is this. Under written down value method is rate of depreciation equal to 1 minus scrap value divided by cost square root of n. So n is estimated life of the assets. So here is scrap value is 10,000 divided by 1 lakh. 10, that is the square root of the 10, so multiplied by 100, so that is the rate of amount of the rate percentage of the depreciation will be calculated. So that is the rate of depreciation. So this rate of depreciation will be taken into account for calculating the amount of depreciation. That is the cost by that means the asset multiplied by rate by 100. So there are two rates are there. That is the rate sometimes vary. Some rate is given 10% for annum. Another rate is given 10%. So the difference between these two is that rate 10% per annum means that is taken into the year, the whole year. They are taken into account if the asset is purchased on July and the accounting year ends on 31st December, then from July to December the rate of amount of depreciation is to be calculated, multiplied by 10, multiplied 6 by 12. That is the time factors. That means simple interest formula is to be used. That is the cost of asset multiplied by rate multiplied by time. But if it is 10%, only 10%, then only the cost of asset multiplied by rate. So for the whole year, the percentage will be remain same. That is not proportionate to the time. That means that is the month or the year. That means irrespective of the year, you have to calculate directly flat rate 10%, 1 lakh 10%. If it is purchased on January, or it is purchased on April, or it is purchased on July, or even on September, and the accounting year ends on 31st December or 31st March. So irrespective of the accounting year ends, for the whole year, 10% means flat rate is to be taken into account. So that is the two rate is there, difference is there. This is the two rate. First you have to understand the rate, then calculate the amount of depreciation, then use the method. Which method you are using? Straight line method or the written down value method? Straight line method. Why this is called straight line method? Because the amount of depreciation will be remain same for the number of years of the assets you use. If, for example, this machinery 1 lakh rupees you used for 10 years, every year amount of depreciation will be remain same. That's why it is called straight line method or the fixed installment method or the fixed percentage method or original cost method. So since the amount of depreciation will be remains throughout the year, that means for the number of years, every year the amount of depreciation will be fixed. That remains same. There will be no changes. If changes, only when that is the per annum is given and the time factor is to be used. Otherwise, that amount of depreciation will be remain same. So that's why it is a straight line method. Why it is straight line method? Because if you plotted in a graph paper, like this is the graph paper, this is y-axis, this is x-axis, this is year and this is amount of depreciation. That means first year 10,000, second year 10,000, third year 10,000, up to 10 years. So it is 10,000. So if it is plotted in a graph paper, then it is to be like the straight line parallel to your base y-axis. So if you plotted in a graph paper, this shows like this. That's why it is called straight line method. A straight line is to be shown in the graph paper. So that's why it is called straight line method. So this straight line method use that amount of depreciation will be remain same throughout the year, through that estimated life of the assets. For the whole year, that all the year that amount of depreciation will be remain same. That's why it is called straight line method, or it is called also original cost method. Why it is original cost? Because on the initial original cost, that amount of depreciation is always calculated. So that's why it is called original cost method or the fixed installment. The amount of depreciation will be fixed, no changes. So that is the first straight line method, and the second one is a written down value method. Written down value method means or diminishing. This is also called diminishing balance method, or this is also known as the reducing balance method, or this is also known as that reducing installment method. The installment amount of depreciation will be changes every year. So here that amount of depreciation, straight line method, amount of depreciation will be constant, fixed, no changes. But under written down value method, that amount of depreciation will be changes every year. That means every year your amount of depreciation will be that calculate the separate amount, different amount. But under straight line method, that amount of depreciation will be remain same. That is a 10,000 every year for the 10 years. But under the written down value method, since the amount of depreciation will be vary, that's why it is called diminishing balance method or the reducing balance method, reducing installment method also. And this is why it is called written down value method, because from the cost of the assets, depreciation is subtracted, the balance assets remains. Upon that, you will calculate the amount of depreciation. But on the straight line method, that original cost is to be taken into account for the calculation of your amount of depreciation. I think you are clear. So if you see here, amount of depreciation is 10,000 every year. But under written down value method, if the rate of depreciation is 10%, then first year it is to be 10,000. So 1 lakh minus 10,000, remaining amount will be 90,000. Upon 90,000, 10% is to be calculated under written down value method. So if you plot it on a graph paper here under written down value method, then it shows that amount of depreciation like diminishing. That means decreases. Every year that amount of depreciation will be decreases till the end of its life. So the main difference between these two methods is that, so under this method that amount of asset never be zero. But if you see this straight line method, that amount of depreciation will be zero at the end of its life. 10 years, every year 10,000, suppose that 10% is the rate of depreciation. So every year 10,000 for 10 years life. So 10 years, every year 10,000 means within 10 years 1 lakh amount of depreciation will be charges. So 1 lakh is the cost of assets, 1 lakh depreciation charge. So it will be, the value will be zero, remaining value will be zero. So under written down value method, if you calculate that amount of depreciation on the remaining balance, first year 10,000, second year 9,000, third year 8,100. So likewise it will be decreases, but it does not be zero at the end of the 10th years. If we calculate it, it will never be zero, some value will be remains. So that is the main difference between these two methods. Then the second difference is that this method is widely acceptable by the Income Tax Act, Companies Act, and the straight line method is not used for acceptable. And third difference is that original cost or the straight line method is very easy to calculate, and the recording of depreciation, because you know that is the amount of depreciation will be fixed, it will be not changes. But under the written down value method, it is every year it changes, so it is little bit difficult to calculate it. So that is the methods of depreciation. I think you are clear. Next comes next, that is the methods of recording of depreciation in the books of account. That means the accounting treatment. So till this we understood the concept of depreciation, nature of depreciation, methods of calculating depreciation, factors determining the amount of depreciation, then causes of depreciation. But the accounting treatment of depreciation is this. So there are two methods of accounting treatment for your depreciation. You can use the two methods. First method is when depreciation charged to profit and loss account. Second method, when depreciation is credited to provision for depreciation account. So there are two methods which to be used. Let's comes to the first method, that is the recording of transactions. So that is the when depreciation charged directly to profit and loss account. That is the first, that is the journal entry in the books of journal. First you will purchase the asset. So asset account debited, that is the cost price plus installation charges plus any other charges at the time of incurred at the time of or spent at the time of purchase of assets till installation, the charges will be added. Then input CGST account, input SGST account. So that is the GST charges will be debited. Then credit to bank account if it is purchased in cash. So remember one thing, when we are recording the transaction, always use the bank, because the payment over and above 10,000 will not be in the cash. So it is in the check. So that's why always use that bank. That is the safe for your transactions. So to bank account if purchased, if for cash. Otherwise, if on credit, then to vendors account. If on credit, that is to vendors account. That is the two vendors or the creditors. So asset account compared to creditors account. Already journal entry, you know it. For assets counts, that is the creditor is the giver. If it is on credit, if it is purchased on cash, cash goes out. So there is the to bank account. So that is the first journal entry. Then second journal entry is for the charging of depreciation. One thing here, this is the date of purchase. So on the date of purchase, you will write this entries. When you had purchased the asset, if you purchase assets on 1st April, then you will do this entry. Asset account debited, GST account debited, SGST account debited. Then to bank account if cash, to creditors or vendors account if on credit, if partly cash, partly credit. So to bank, to vendors. That's why it is written. So this is the first entry, that is on the date of purchase of assets. Remember, date of purchase of asset, that is the purchase of asset entry will be given. So when asset is purchased, then you do these entries. If asset is not purchased, suppose asset is not purchased, that asset balance is there, then this entry will not be done. So this is not to be done if asset is not purchased, already balance is there. So directly you will start from the second entry, there is the depreciation charged. So depreciation always charged on end of year. End of year. End of year means that is on 31st December or 31st March. That is the date of accounting year ends. When accounting year ends. So that is depreciation account debited to asset account. So depreciation charged for the whole year. If it is per annum, then calculate accordingly. Cost of the assets, rate of depreciation multiplied by time. If it is 10%, only 10% is given irrespective of the year, then at the flat rate directly you will charge the amount of depreciation. That means at the flat rate 10%, 1 lakh 10%, 10,000. So time factor will not be taken irrespective of the date of purchase of asset. That you should be taken into mind. So that is the purchase, date of purchase of asset. So that is the date of purchase of assets. If it is 10% per annum, then date of purchase of asset is to be taken into account. If 10%, only 10%, then date of purchase will not be taken. So flat rate. So this is end of the year on 31st December or 31st March on which your accounting year ends. So on that date, you will record the transactions, that is for depreciation. So depreciation account debited to asset account. Asset decreases, credited, depreciation is the loss of assets. It is the non-cash expenditure, expenses or losses debited. So depreciation debited, asset credited, because assets decreases. So that is the depreciation charge. Then third entry. So we are discussing under the first method where depreciation charge to profit and loss account. So third entry for transferring depreciation to profit and loss account. So when we are transferring depreciation to profit and loss account, then we will record. So here depreciation is debited. So that is on the same date again, end of year. End of year. That means on 31st March or 31st December, last these two entry will be done. So depreciation charge then transfer to profit and loss account. So that is profit and loss account debited to depreciation account. So that is depreciation here debited. So depreciation here credited, profit and loss account debited. So depreciation, all expenses losses are shown in the profit and loss account debit side. So profit and loss account debited to depreciation account. So this is the what journal entry is to be done on the depreciation charge directly to profit and loss account. If depreciation charge directly to profit and loss account, then these two entries to be done. Then fourth entry, that is for sale of assets. If any assets are to be sold. So likewise, the purchase of asset, sale of asset, you can do it. So that is the bank account debited or debtors account debited to asset account to CGST to SGST account. So this is the entry you do it. So when asset sold. So that is the when asset sold. So this entry is to be done. So that is the bank account debited. That is means the asset is to be sold for some price. So bank account debited. Debtors account debited to asset account because asset goes out. Cash is coming. If it is for cash, if it is on credit, then debtors is the receiver. Debtors account debited to asset account to SGST to CGST. That is the GST part. That is the output CGST, output SGST. If GST is given in the question. So that is the journal entry for the sale of assets. Then find out the profit or loss. How will you calculate the profit or loss? What is the cost of the assets? Depreciation charged on the date of sale. This is date of sale entry. So on the date of sale, you will do these entries. Then calculate the profit or loss. Till the date of sale, how much depreciation charged? And what is the cost of asset? Suppose the cost of asset is get purchased for 1 lakh. But the depreciation charge for 3 years, 10,000 each every year on straight line method. Then 10,000 each means every year 10,000, 10,000, 10,000, 30,000. But the sale price of the asset is suppose 50,000. So 1 lakh minus 30,000 depreciation, remaining value is 70,000. But sales price is 50,000. So difference amount, that is the profit or loss, that is the loss. So likewise, you will calculate the loss or profit on sale of assets. If loss, profit and loss account debited, asset account credited. If profit, that means bank account debited, debtors account debited, to asset account, to profit and loss account. So here profit and loss account debited if losses, profit and loss account credited if profits. So this is the journal entries for recording of transaction under the first method. So let's come when depreciation is credited to provision for depreciation account. So this provision for depreciation account is to be used when depreciation is not directly charged to profit and loss account. So under this method, the first entry will be remain same, purchase of assets. Then second entry, that is the depreciation account. So here, so this is the depreciation account debited to provision for depreciation account. That means the instead of asset account credited, provision for depreciation account is credited, because this provision for depreciation is to be created for the charging of depreciation. So depreciation account debited to provision for depreciation account. Then third entry, profit loss account debited to depreciation account. This entry will be mentioned. So only the difference is here, that is depreciation account debited to provision for depreciation account. And this provision for depreciation account will continue till the end of the year of the assets, till the asset is replaced. When asset is sold, here what we will do, there is the bank account debited, provision for depreciation account will be debited here. If asset is sold, then to asset account, the difference amount will be either profit or loss. So this is the methods which is to be followed for the when depreciation is credited to provision for depreciation account. Only the difference is that asset account first entry remains same. Second entry, here instead of depreciation to asset, you will do depreciation account debited to provision for depreciation account. And third entry will remain same, profit loss account debited to depreciation account. So when asset is sold, so here, so provision for depreciation account debited, then to asset account, then the difference is either profit or loss on the sale of assets. So this is about the methods of recording of depreciation. So from journal entry posted to ledger account. So in ledger account, there are two ledger account, input and ledger account you will prepare. If the first method is to be followed, then first is your asset account, then the second is your depreciation account. Asset account purchases assets, depreciation charged, then the balance comes. So likewise it is continue till the end of, till the date of sales. If sales, then buyback, so difference amount will be then balance coming. And in depreciation account, so depreciation account debited to asset account, then by profit and loss account. This will be continued. But under second method, so three ledger account you will prepare. One is your asset account, second is your depreciation account, and the third one is your provision for depreciation account. This is the third additional one account you will prepare. This is for when depreciation is credited to provision for depreciation account. So this is about the accounting treatment for the recording of transaction. Hope you had understood it. So this is about the methods. Today we will discuss about the methods of depreciation and methods of computing depreciation, how methods depreciation is to be calculated. That is the important part. So two methods we had seen, straight line method, then the written down value method, and then recording of depreciation. So accounting treatment, journal entries, first you calculate, then do the journal entries. So this is depreciation, charge to profit loss account. Either of the methods computing of depreciation is to be followed. When depreciation credited, provision for depreciation account, either of these two methods is to be used for recording of journal entries. Then posting to ledger account. So hope you had understood it, enjoyed it. Thank you.